Hi everyone. Today we are going to discuss what is open interest, what is PCR, put call ratio, and volume. Open interest is one of the main indicators that most of the professional traders are using. Whether you're professional or amateur or whatever it is, without checking open interest, you will not be able to read the market properly. And without reading it properly, you will not be able to take a trade. So whether you are trading in options or future, you must check open interest on daily basis before taking a trade. So let's discuss and see what is the importance of open interest. So open interest is the number of active contracts for any given security during any trading period. It is the most useful tool for analyzing potential trend reversals in futures and option market. So open interest shows the active contracts available for any given security, whether you are trading on security, stock, index, or anything. You can check what is the open interest for that particular strike price or expiry day. So if you go to NSE website, you can see open interest. You choose the strike price or you choose expiry date, whether where you want to take a new trade, then you see the open interest for that particular strike price or expiry date. Call rate is high or put rate is high. If call rate is high, then that may go down. If put rate is high, means there are buyers ready for that. Let's see what is the definition of open interest. Open interest is the total number of contracts entered into during a specified period of time that have not been liquidated either by offsetting transactions or by actual delivery. So here you can see the active number of contracts entered into during a specified period of time. Normally open interest is updated for on daily basis, the day transactions, but of course the NSA is giving, I think, 3-minute gap charts. So open interest is always changing, that keep on changing, doesn't stay in one direction, because when markets go up, put call will be high. When markets go down, call will be high. So open interest is the total number of contracts entered into during a specified period of time that have not been liquidated. So it means it's not liquidated yet, not closed yet. So it is open. So it is live. You can see what is the direction of the market. Open interest applies to futures and options. So calculation. What is the calculation? Open interest is calculated by adding all the contracts from open trades and subtracting the contracts when a trade is closed. So whenever a new trade comes, that is being added, and when something is closed, it is updated immediately. And that measures the total number of short and long positions. Hope you know what is short and long positions. This video is actually not meant for the beginners, so those who know the basics of stock market and options, hope they know what is short and long positions. Here you can see open interest chart from NSA website. Here you can see calls, and there is a number down, and puts on the top and a corresponding number down on the right corner, which is highlighted in red color, blue color. So here calls 1993,557 and puts 1698,601. What does it mean? It means call contracts are more than put calls, because call contracts are 19,93,557 when put calls are 16,98,601. So based on this, you will calculate what is the put call ratio, which will help you to read the market properly. But not that this is not the only indicator that will decide market is bullish or bearish. There are many other indicators. This is one of the indicators or one of the main indicators that will decide whether market is in positive direction or negative direction. So one of them, put call ratio. So we get put call ratio from this open interest. Put call ratio is the most commonly used sentiment indicator for trading futures and options. Put call ratios, when at extremes, can be signs of excessive fear and excessive greed. Excessive fear means market is going to fall, and excessive greed means market is going to fly, to go up. So this is one of the most commonly used sentiment indicator. Why it is called sentiment indicator? Because this is showing the sentiment of the market, whether it is positive or negative. What is the formula for finding put call ratio? You take total put options purchased divided by total call options purchased. You have seen the previous, you have seen already what is put call contract and what is total put options purchased and total call options purchased. You have seen in the previous slide where I have shown the NSE website open interest data. So when you do that calculation, if you get above 2, it traditionally is a bullish sign, but when it falls below 0.9, it becomes bearish and traditionally signals that some kind of correction is coming. So you have seen open interest data and you have calculated what is put call ratio. Then the answer is 2. That means a bullish sign, and if it is 0.9, that is a bearish sign. See, this is a general idea about put call ratio, but it doesn't mean that when you get 2, market is bullish. No, there are some other indicators to be checked, and in line with put call ratio, then you can conclude, you can decide that the market is bullish or bearish. Please do not take only put call ratio and decide the market is bullish or bearish. That will mislead you. Because because these numbers are not as reliable in traditional sense as they used to be. Please do not take any trade based only on it. Instead, consider them only as reference points. What are the other indicators to be checked while checking put call ratio or before taking a trade? Those are price action and chart patterns. So all these 3 are in one direction, then yes, you can finally say that the market is in positive direction or negative direction. So if you get a figure which is not 2 or 9, or you get a figure between these 2, market can be sideways move. It means the market is not going to go up, not going to go down. So what we have to do, we have to combine open interest and volume. Actually, we have to combine open interest, volume and chart patterns. Generally, open interest and volume need to be heading in the same direction. A rising market with shrinking volume and falling open interest usually is one that is heading for a correction. So this is an example. See, a market is rising, but when you check the volume, it is shrinking. And when you check the open interest, that is falling. So what does it mean? Even though it is a rising market, but with shrinking volume and falling open interest, you are expecting a correction there. you're not expecting a further up move there. That's why I said that we have to combine these data together, and then only we will be able to read the market's direction properly. So here there is a chart which shows what actually gives a clear direction whether market is strong or weak. See, the price is rising. The first example, volume is up, open interest is up, so market is strong. Look at the second one, price is rising but volume is down, open interest is down, then the market is weak. Even though the price is rising, market is weak. Why? Because there is no volume and there is no open interest. Let's take the third one. Price is declining, volume is up. There's a spelling mistake. C is missing there. Read it as declining. Price is declining, but volume is up. Open interest is up, but market is weak. Why? Price is declining. The last one, price is declining, volume is down, open interest is down. So expecting a strong market. Just take this chart as a reference. Hope you understood what is open interest and what is the importance of open interest in option and future trading. Without checking open interest, do not enter into any trade. Not only open interest, we have to check the chart patterns and we have to see the volume and we have to check the open interest, put call ratio. So what is put call ratio? When put is high, that gives a sentiment that the market is strong, it is going to go up. But when call purchase is high, that means the market is going to fall, because those who are buying call, what they anticipate? They anticipate a fall in the market. That is why people are selling call. But when people are selling put, they expect market to go up. So when put is high, market is positive. When call selling is high, market is negative. But this is the only indicator? No. We have to see the chart patterns, because market may change anytime, correct anytime. Put becomes call immediately. People will write put, people will write calls. Market, when market is running, and it can change. You can see the graph. The chart shows what it is not. It is not in the same direction always. It is going up and coming down and going up and then deep fall, then correction, then again going up, resistance, support, so all this. So you have to see the open interest data properly before you take a trade. Then you have to monitor the data and react or take a decision accordingly. Thank you for watching. Wishing you all success.